Hello and welcome to episode 2 of Money Anonymous. I'm Kira Jones, money coach and founder of Financial Intervention Academy. And in today's episode, we're going to be answering questions about high yield savings accounts, how to shop car insurance, and saving on a single income. These episodes were previously recorded from when I did Money Monday live, but I still wanted to bring them to you as the first few episodes of this, my first segment on YouTube. So let's jump right in.
What is the high yield savings account? More so, where do you get one? We need somewhere to put about 20,000 in the beginning of next year. That's great. That's a great windfall. So I've got two things to answer your question. Let me stop sharing here. Let me share something else here with you. Okay, so Investopedia has a great article that they update all the time with all of the current annual percentage ratings for the high yield savings account. So right now, the highest that's available is up to a 5.35%. So that's Brio Direct. But here they'll go through and they'll tell you which one of the ones, what their APY is, the minimum amount to get into that. And then there's also some highlights, like this SoFi, you can earn up to $250 if you're direct depositing, no account overdraft or monthly fees, and it's $0 to start. But if you do at least, follow their steps, you can earn free $250. And then of course that money sitting there is 4.5%. Why is this important? This is important because, traditionally, if you have your money sitting in a savings account, it might only be earning 0.25, maybe 1%, depending on the savings account, like if it's at a credit union. But more than likely, that interest that you're gaining isn't enough to keep up with inflation. If it's not earning at least 2 to 3% interest, then over the long term, they say that your money sitting in that account is losing money every year because of inflation. So when you put it with a high yield savings account earning 3% or more, at least it's going to earn enough interest to where it's not like taking away from your money. So just kind of scrolling through here, there's tons of really great options. Obviously, some have a really high deposit amount in order to get started. Citibank has just $1 to get started. You can get a 4.35%. And then there's some down here with, various different ones. Again, there's that Brio Direct. Never heard of them until I looked at this, but 5.3% APY. These are great because, you want to get your money in. A good rule of thumb with your emergency fund or sinking funds or your savings is that I like to recommend that you have 1 full month of expenses in a savings account that is directly tied to your checking account. So it is quick access. You can move it over there. Like, oops, if I don't have enough to cover that bill, I get on my app, I move it over. It's right there. A lot of, the electronic banking now does make it seamless to move money between accounts. But, the idea that a lot of these banks are not your traditional brick and mortar banks. So they can offer better interest rates on these products. But again, it's not brick and mortar. So you can't just walk in and say, hey, I need to withdraw $1,000. So in which case you'll have to set up like electronic transfers. Sometimes those can take a couple days. So it's not exactly as liquid as cash on hand or the money you have in your savings account that's tied to your checking account, which usually at like a brick and mortar account. So, if I have my 1 month of expenses in my emergency fund that's tied to my checking, then I'm going to want to save 2 to 5 months worth of expenses in a high yield savings account as the emergency fund, or anything that you're not going to want to access very quickly or anytime soon. Put it over into the high yield savings account. That also adds another layer protecting from our human brains so that we can't just be like, oh, I want to make that purchase, so let me just move some money right over real quick. It puts a buffer between you and our impulsiveness. So that way you kind of think about that purchase a little more. Do I really want to pull money out of my long-term savings when it is earning 4.5 to 5.35% interest? Do I really want to pull that out and spend it on this? But obviously the rule of thumb for an emergency fund is anywhere from 3 to 6 months worth of expenses. So putting most of it in a high yield savings account is going to be your best bet. Car insurance would be the cheapest for me. based on your experience knowledge, I got a DUI last year in a car accident while on my mom's insurance. I also have a wreck from 2017. When I get to the point of being able to buy another car, what insurance company would be cheapest with 2 wrecks and a DUI? I'll be on my own insurance and I'm 23 years old. Okay. So a few things here. You got a DUI last year, so I'm going to assume that was in 2022. And you're 2023 now. So the wreck from 2017 actually is not affecting your insurance anymore, because in the insurance world, they only look back 3 years as far as claims. So then the next step is, who do you get your insurance through? Would that be an insurance broker? Or are you going to call around and shop insurance yourself with what would be captive agents? So captive agents such as State Farm, Allstate, Geico, these companies only sell their products through their agents only. Now, an insurance broker, with these insurers aside, a broker is going to work with several different companies. So where your rate goes up with one, it might have gone down with another. This whole thing of switch and save hundreds. That's because every insurer kind of has their flavor of people that they like to insure. And so I might switch back and forth between Progressive and Safeco, for example. Every 6 months, I might switch back and forth between them. But my broker handles that. That's one of the beautiful things about having an insurance broker. The broker knows you personally. They know your life. They know your assets, your toys. They know what you need insured to cover your risk. And then every 6 months, they run your rates through all of the carriers that they work with, and they bring you the cheapest rates, or the cheapest policy between all of the carriers that they work with. If you go to State Farm, they're only going to sell you State Farm, and actually State Farm's pretty expensive. That's just personal opinion. I love my broker. I'm definitely biased. Shameful plug to Ziskowski Insurance. If you're in Ohio, they are wonderful. They work with so many different carriers. And, they also aren't going to sell me a crap product, because, if you're on state minimum policies, we all know how expensive things are these days. Those state minimum policies might not cover you in a true event that something happens. Because what's insurance for? I always love Chris Rock's. It's Chris Rock's comedy statement. He was like, that's in case shit happens. Well, stuff does happen, and it is expensive nowadays. So having a statement policy means that you might not be fully covered. And then if you have a claim that is going to pay out more than your policy is going to cover you for, you are personally liable for that. You can personally get sued for that amount. So a few things for you to consider also. You're 23 now. 2 years from now, if you wait, save up a bunch of money, buy a car with cash, you're going to have cheaper insurance because, one, you don't have a loan on it. You may or may not have to have full coverage. You won't have to have full coverage if the car's paid for, but if the car's worth some money and you can't afford to replace it, you might want to carry full coverage. But 2 years from now, also, you'll be 25 years old. And for a lot of insurance carriers, once you kind of get up over that 25-year threshold, for a lot of carriers, your rates go down. Now, years ago, I did see that for like women, it was 23 and guys, it was 25, or women 25 and guys 27. But either way, the older that you get, the more your premiums are going to go down. And so with the wreck and the DUI that you got last year, if you wait till you're 25, those 2 instances will be off your insurance report, because it's going to be outside of that 3 years for claims. So you're going to be in a really, really good position. If you wait a couple years, wait till you're 25, buy a car with cash, you're going to have some pretty decent insurance. So I wouldn't necessarily worry about it. It would be finding a good broker. I would call a couple of local brokers in your area and, just kind of ask how many carriers do they work with? What kind of policy coverage do they offer? Again, I love my broker because they don't necessarily write statement policies, because they want to know that when you call in with an issue, they want to be able to say, you're covered. We got you. So good luck. Save up what you can. Highly recommend you buy with cash. And if not, make sure to put at least 20% down, so you don't wind up underwater like so many people are finding themselves in lately. Our first question tonight: need help. Single mama looking to start saving money. I get about $2,400 a month from my job, and all my monthly expenses total up to about $579. what would you recommend I save each check? I want a decent amount while still having enough money to buy me and my son clothing and shoes, and also just extra money for groceries, going out, and gas. Okay. So, black and white answer to this would be budget with the 50/30/20 method. So with your $2,400 a month income, that would mean 1,200 goes to your needs. So the needs, the bills, expenses, that kind of thing. You'd have $700 a month to spend on wants and $480 a month to go to savings. So a black and white recommendation would be save a 6-month emergency fund for you. If your expenses rounding up to 600, that would be $3,600. And then you'd start funding a Roth IRA if you don't have any investment plan with an employer, or a 529 education plan, since you have a child that obviously sounds like they're young, but you'd want to start saving so that way they have a decent education plan for them when they are ready to go to school. What about saving for a car and a house? So that's where coaching would kind of come in. Like, what are some of the other goals that you're trying to do and accomplish? So it might not be 50/30/20. It might be more like, 40/40/20. But you have a great debt to income situation. But how's your savings in your emergency fund? I would do, if you were a client, I'd do a little bit more why work. So, why do you want to save money? Is it just about stability? You're thinking about your son, but can we dive into that a little bit more? What type of experiences do you want your son to have? Are we saving for him to like play all the sports, or, what are some of these things? Like, where do you want to spend your money and why? That's what coaching would dive into. And then from that, we could kind of start setting a plan, because you have great income versus your expenses. So let's really maximize what that could do for you. All right. So question number 2. So I'm currently stuck in a dilemma. I decided while I was a stay-at-home mom, I'd go back to school and finish getting my associate's degree. With my husband being in the union, I was able to obtain free tuition, but they have since done away with it. I don't qualify for aid or anything, and the idea of taking out a student loan with rates these days is terrifying. Am I better off just going part-time and paying it in cash and finishing whenever I finish, or bite the bullet and just do the loan? We will be completely debt free by the time I finish my associates, or at least a majority will be paid. But again, the idea of owing thousands for 2 semesters sounds depressing. I hear you. It is an expensive time for sure, but it sounds to me like you've got a few different options here. So basically, like the black and white answer, Susie Orman would have you take the loans. You can pay them off with your income after you have a degree. Black and white answer, Dave Ramsey, he would have you avoid the debt like the plague, cash flow your education all the way. So the coaching answer would probably be a mix of both. Again, that yes and situation. So how about just get your feet wet with a few courses and adjust going back to school and cash flow it. After a semester and you see how you do, maybe you can increase your class load, and then fund a portion with or a majority of it with cash, and maybe only take out loans to cover what you can't with cash. Another coaching example would be like, do you have a fully funded emergency fund before we do this? Maybe helping you seek out grants that you're more than likely eligible for, some types of grants, which could definitely help reduce that loan burden that you are trying to very much avoid. So lots of different options here. And with, a financial professional to help you navigate those options, you could feel more confident with going back to school, and whichever way you decide to go with it, loans or paying in cash, you've got a solid financial professional to help you handle that. That would be my recommendation.
All right, that's it for episode 2 of Money Anonymous. If you would like to submit a question to be answered in a future episode, please complete the anonymous Google form. The link for that is in the description below. This video is for educational purposes only. It's not meant to be financial advice, because personal finance is just that, very personal. So if you have any experience with the situations that we discussed in today's video, please contribute to the conversation in the comments below. I'd love to hear your experience with these things. So because with more knowledge, we have more options, which means smaller emergencies. So we'll see you in the next episode. Be well, friends.